welcome everyone. I'm Lori Berman, Vice President of Membership and Development for the Small Business Association of Michigan. Thank you for being here today, being part of today's webinar. Exciting topic, much to learn about the Employee Retention Tax Credit. Special thanks, obviously, to our speakers today, but also to the Michigan Association of Certified Public Accountants, the MICPAs. They have been a great partner helping you, our members, through the small business issues that have been related to everything that's happened in the past year and a half. So thank you so much for the Michigan CPAs for being our partners in this. Special thanks to Jamie and Bob. Before I introduce our two speakers today, let me tell you that this session is live on Facebook. It's also being recorded live on Zoom. We will send you the link. You can watch it later if you would like, if you'd like to come back or share it with friends. And also there will be slides today and we will share those with you as well. If you have questions, I ask that you use the Q&A feature in Zoom. We'll help monitor those questions and give you answers. I know I have a few questions already that some anxious listeners have sent in prior, and we will get to those as well. Just ask that you keep your questions related to the ERTC. We also have a publication that was put together with the CPAs and SBAM that's on our site, and I'll drop that link in later. Without further ado, Jamie and Bob, welcome back. You have been with us quite a lot over the last year. I can't thank you enough for the expertise. Just quickly to tell you who Jamie and Bob are, if you're not a regular viewer. Jamie comes to us from the Michigan CPA Board of Directors, actually. Thank you for lending Jamie to us. Jamie's day job, CPA, a CGMA, and founder and proud owner of Capital Corp Professional Advisors, which is a CPA firm located in downtown Lake Orion. And Bob Wines also comes to us, a CPA attorney, graduated from the University of Michigan, and Bob is COO of Insights 3, which serves as a confidential advisor to high-profile business leaders. So thank you both for being here. Thank you for the subject. I know that you had a busy season already with some folks that had October year ends for their financials, and now you're back in the thick of things again for those of us that have calendar year financials. So thank you. I'm going to let you guys take it from here, and we'll help you monitor the Q&A.
Sounds perfect. Thank you, Lori, and thank you for the invite again from SBAM. Bob, welcome back. It's glad to have the band back together here now. So
I agree. I'm missing Leon, but he'll join us for later ones. And it's kind of an interesting comment on our idea of a great event or social event with COVID, when an ERC discussion is something that's exciting. So
right.
Yeah.
So Lori, I just want to make sure everybody can share the screen. It should be an orange screen with the Employee Retention Credit title.
Yep, looks great.
Okay.
We can see it. Thank you.
All right, good. So yeah, hopefully, Bob, this will be our as Bob and I were talking, we're hoping this will be the last and final act relative to everything that the CARES Act has given us. So we'll get right into it and go from there. So with that being said, let's move on to just a little bit of a summary of what the ERC is. And we're going to try, Bob and I are going to try to keep this a little bit conversationalist versus just a standard lecture. But the ERC came from us from the CARES Act originally, and it allowed for an alternative to one of the three major ways to get some funding to employers relative to trying to keep people employed. The first go around allowed for a credit of 50% of qualified wages and was a maximum of $5,000 per year. Bob, I felt that this one was very underrated just because of the fact that it originally, as written, you couldn't commingle it with the PPP, but that all of a sudden changed at the end of December of 2020, didn't it?
It did. For most of us, we didn't apply for the employee retention credit. Why? Because you couldn't apply for the ERC and the PPP. And the PPP for most of us is worth a heck of a lot more. So to be candid, in 2020, we ignored the employee retention credit. In 2021, it's no longer true. They said, oh no, you can apply for the PPP and the ERC. You can get both. In fact, you can go back to 2020 and apply if you qualify. And then they also increased the ante and made it easier to qualify. Beforehand, you had to show that you had a 50% reduction in your gross receipts from the current quarter to the same quarter in 2019. In 2021, they said the reduction only has to be 20%. So if you got a greater than 20% reduction in Q1 2021 compared to Q1 2019, you qualified. On top of it, they made it much tastier. Beforehand, the credit was 50%. Now it's 70% of qualified wages with a max of $7,000 per employee per quarter instead of $5,000 per employee per year. So long and short of it is the PPP was great. The ERC for many of us actually exceeds the benefits that you got under the PPP.
And the beauty of this is that under the new law, you could go for both. You could go for PP. So it was by combining them together, this was a huge amount of money that employers could go back after. And I mean, I remember having conversations with you and stuff relative to, you know, at first, if we think of the roller coaster that was the PPP and the forgiveness, at first time we were, you know, first blush out, we were trying to figure out how to get everything crammed into what was it, 8 weeks or whatever it was going to be.
Right,
and then next it was, well, they changed it in June where it didn't make a difference. You had 24 weeks. So it was just free reign, just whatever you spend in wages. And then in December, they throw this at us. And now we had to balance out what wages were going to be used for PPP and which wages were going to be used for ERC. So it's been an interesting ride as they've kind of updated the CARES Act as we've gone through this pandemic. So with that being said, there's a couple of rules relative to who can actually qualify or what they determine an eligible employer for the ERC. And there's two ways that they're looking at an eligible employer. They're looking at one is just being somebody that had suspended or either fully or partially operations in 2020 and of a government order. And in Michigan, our state at home orders basically covered from March 23rd to June 1st. So that's when the governor had the stay home, stay safe orders. And then, so if businesses were shut down, then they would be eligible for and still continue to pay their employees, would be eligible to do that. There were a little bit of confusion with some of this is depending on the businesses. They may have been earlier or later based upon the government shutdown. I know restaurants had a little bit of a partial shutdown through most of 2020, so they would qualify possibly for a little bit longer. And then we have issues relative to the telework that may not have qualified. Essential employees or businesses were not considered eligible employers as well. But Bob, from my understanding of it, you could be both. You could be an essential business for part of your business, but also have part of it be not essential, and that non-essential could qualify you as an eligible employer.
It would, because you're partially shut down because of the order. Yeah.
Right. So you'll have to look back at where you were at relative to 2020. But I think for the most part, most of my clients, Bob, and I don't know about yours, most of mine qualified under the second definition of an eligible employer, which was experienced some type of declining gross receipts. And in 2020, under the original act, it was a 50% compared to quarter by quarter, compared to the same quarter in 19. But in 2021, we saw that decrease go to 20% only. And Bob, you know, early on, you had talked about this, and you and I have had conversations that these quarter decreases can also be looked at. We'll talk about those a little bit later in the slide deck, but you didn't necessarily have to be the exact quarter. You could have gotten something in the quarter earlier to that then as well, right?
Right. So for example, you can look, if we qualify, and this is a scenario we'll hit later, let's assume that in December of the fourth quarter of 2020, that we have a 20% reduction in our gross receipts compared to the fourth quarter of 2019. Well, for 2020, do we qualify? Well, no, we had a 20% decrease, not a 50%. So we don't qualify for the 2020 employee retention credit. But the rules are very clear, the new rules. They basically said you can use for Q1 2021, we could use January, February, March of 2021 and compare that to January, February, March of 2019. If we qualify, we have more than a 20% reduction in gross receipts, great. If we don't qualify, we can go and look back to the prior quarter. So we can look at that Q4 2020 and say, oh, well, we had more than a 20% reduction then. It didn't qualify for the 2020 credit. It does qualify for the 2021 credit. We're going to use that prior quarter to let us take the ERC in Q1 2021. So long and short of it is this. You can look to the quarter you're in. If you qualify with the 20% reduction, you're good to go. If you don't qualify, look to the prior quarter. You're going to hit this interesting scenario where you might qualify in Q4 2020 on its own. You get a 20% reduction. You can use that for Q1 2021. Let's assume Q1 2021, you don't qualify on your own. You didn't have a reduction at all, let's assume. Well, you still get the Q1 2021. When it comes to Q2 2021, you run the test again. If Q2 passes on its own the test, so you had more than a 20% reduction in Q2 2021 compared to the same quarter, Q2 2019, you qualify for Q2 2021, and you'll automatically qualify for Q3 2021.
Yep.
So you can double dip.
Right. And they did that for the most part, Bob, didn't they? Just because of the fact that, you know, the way that this credit was designed was to be a reduction of current quarter payroll taxes and get the money, you know, originally is designed for get the money back in the quarter that it applied to by reducing your deposit. So you had the money at that point, you know, live, if you will, to be able to pay your employees. I think what most of us have though experienced is that this is more of a, hey, let's go back and get this money now versus doing it in the quarter. But that's why it was designed to allow you to look back at the previous quarter to move forward.
It is. So you could look at your current quarter and say, I qualified for this quarter. I know automatically I qualify for the next quarter. Therefore, I can start getting the credits applied immediately.
Right.
And it reduces my cash flow requirements. Yeah, Jamie, that's the exact reason they did it. But the interesting thing is the IRS is very clear. You can double dip.
Yeah, even if you go back on an amended return. So, which is good because it gives everybody a few options to possibly cover. We've got a couple of questions in the chat and so forth. You know, a couple of them are related to the timing of the ERC, and I don't necessarily cover that in these slides, but based on my personal experience, I've talked to those that have filed for the ERC as part of the and we'll talk a little bit of the mechanics is the amended returns were paper filed, so it had to require for the IRS. So if you went backwards, it was a paper file and requires the IRS to go through the processing. I'm hearing anywhere from 6 to 9 months for them to process that. In fact, people that have been, I did this presentation to a group of CPAs about a month and a half ago, and they were reporting people in February that they filed amended returns for 2020 are just now starting to get those refunds back. However, those that filed perhaps live with the 2021 returns, meaning that you filed them as part of that current first quarter 941, since those were filed electronically, those refunds are coming a lot quicker. So part of it is going to depend on how you filed the return will determine the timing of it, because the IRS is still backlogged on a lot of paper processing, from my understanding. And there's somebody that talked about discuss the impact of the drop in employees and wages reduction in the PPP. We'll be covering, just stay tuned. We'll be covering that as how does this all interact with other down the road. So we'll keep that one live, pinned, and then we'll come back to that question for you. So just stay tuned. So a little bit of a suspense, I guess, for you guys. I'm learning from the news agencies, I guess, little teasers, right? Is that what they're called? So, all right. So moving on. So we talked about eligible employers. The next thing is to talk about is what is considered qualified wages. So you've passed the first step, and either
Let me jump back to one thing on your prior
yeah.
slide, just real
Yeah.
quickly. So just, I guess the one thing to pay attention to, and this is, if I had to give you flags to go to talk to your tax professional, your CPA, your attorney, whatever. If you've got a 20% or 50% reduction, you should be talking to them to say, oh, should we be filing?
Right.
If you don't have a 20 or 50% reduction, but you had to reduce or shut down operations because of the state order, you should be talking to your tax professional again, because you could still qualify. So even though your receipts may have gone up for some fluky reason, though you reduced, you couldn't run full time, you're partially shut down or fully shut down, go ahead, talk to your tax professional, because you might still qualify.
Right. And the only, and we'll get into this a bit as we get into the qualified wages, is that the difference on the shutdown becomes a little bit more challenging because you have had to still pay your employees during that time period. That's the biggest issue with the shutdown period. I know a lot of my clients were shut down, a lot of dentists, doctors and so forth, but yet they laid off all their own staff as well. So even though that they were under a government shutdown, they still weren't going to qualify. I think that the industries that are going to see something here is going to be the partial shutdown related to the entertainment industry specifically, because more than likely you may have done, especially restaurants or something, you may have done carry out. You were still partially shut down because you couldn't have in-seat service. So from that perspective, you were still paying employees. You may still qualify during that time period.
Mhm.
So that's kind of, if you're looking at industry specific, and I know we've got a wide range on this call today. There may be some, like as you said, Bob, talk to your preparer or your tax professional to find out. Hopefully they're a CPA, but if not, hopefully they can walk you through that. So as you said, that the first step is to determine, am I an eligible employer? Do I qualify? And then next is what qualifies for the credit? What wages do we pay that qualifies for the credit? And there's a whole host of things here. And this is probably the biggest contention of conversation among professionals of what qualifies and what doesn't. But in general, the rule is all compensation paid to an employees, including their tips. So if you paid their tips and they show up on their W-2, then they would be a qualifying weight. That compensation would qualify. Any company paid health insurance, which is something that I've never seen before, but they're including that health insurance as part of this. But of course, if the employee is paying a portion of it, it's not. And again, it has to be compensation paid due to economic hardship, full or partial shutdown, or again, significant decrease in gross receipts. Those are the qualifying qualifiers to determine if the compensation had to be paid during those events. And then they start to break down. They did something interesting, Bob, with breaking it down between large employers and small employers, and kind of defining which is their qualified wages for each. So you have to then kind of, first you determine if you're eligible. And then now we've got to split into these two groups, whether large employers or small employers. And originally I found this ironic is that they define large employers as anybody over 100 full-time equivalents. And then they upped that to 500 for 2021. So you can really see the transition where Congress really wanted more people to get this ERC as a way to give them money, as opposed to the original CARES Act, which was very conservative in nature, I think, in the way that everything was written very narrowly. And as they saw this pandemic kind of not, coming to an end anytime quickly, they really opened up the coffers and allowed for more people to qualify for these things.
They did.
And so the large employers, the issue with the large employers is that you could only get the credit for compensation to paid employees who you were still paying, but they were not doing any work. So for example, let's say you had let's say you're an engineering company and you had some engineers working and some not. In lieu of taking those that were not working and putting them on unemployment, but you continue to pay them, they would qualify for the ERC. Now, Bob, you and I were talking beforehand that there was one exception to this large employer that would still qualify, but they had to have a significant decrease in gross receipts. Why don't you tell us a little bit about that one?
Yeah, because what's happening here is if you have, let's look at 2021. If I have 500 or fewer employees, whatever comp I pay, so whatever cash compensation or my portion of the health insurance, whatever I pay for my employees for that, I get to qualify for the ERC. If I'm over 500 employees, like Jamie said, only the wages and the health insurance I'm paying for employees that aren't performing services for me qualify. The federal government, the Congress went through and said, you know what? If you're a large employer, you've got 1,000 employees, and you have more than a 90% reduction in your gross receipts for the quarter, then you still, any wages you pay to anyone, working or non-working, providing services, not providing services, it qualifies for the ERC. Let's face the facts. If you're running on less than 10% of your gross revenue compared to the same quarter in 2019, you are truly, truly struggling. I think this was probably looked at as some of the chains of movie theaters and restaurants, et cetera, that had high numbers of employees. And they basically said, you know what, give them the ERC. So.
And then we get into small employers. Those are under 100 full-time or 500 for 2021, and all employees, regardless if they were providing services or not, were considered qualified wages. And we've got a question here from Amy, Amy, I want to thank you very much. I'm glad to see that you're on this call. We got your email earlier today, and Amy came up with a lot of good questions. And hopefully, Amy, as we go through this, we'll answer these questions that you sent us in the email. If not, then maybe we can talk offline. But one of the ones that she's asking is for a small employer, do part-time employees qualify? And the answer is yes. It's just where you have to use the part-time is in your determination of the full-time employees. Yeah. Bob, do you agree with that?
Yep.
Okay.
It's just your head count if you're above or below that 500 head count now for FTE. In 2020, it was a 100 head count.
Right. And then Amy, I think this is the same question you asked in the email, but I think you've asked it in a little different way. If you hadn't formed your business until late 2019 or early 2020, so gross receipts don't qualify you, but you were partially shut down by order, can you still qualify prior to Q3 and Q4 of 2021? You would only be able to qualify during the period that you were shut down. So the difference is the gross receipts test allows you to take the entire quarter if you were decreased by gross receipts, whereas the shutdown, only the wages paid during that shutdown period qualify. So as far as I know, there's no state ordered shutdown in Michigan anyways any longer. So I don't see where the shutdown would be able to apply for any quarters of 2021. Bob, do you see it differently than I do?
No, let me take a quick look at it. Did she pick up when did business start?
She says it didn't start until late 2019 or early 2020.
If it's early 2020 and that happens to be after February
15th, then she would be, which we'll talk about in a little bit.
Then she might be able to qualify under the startup recovery startup business.
Right. And if she had a full quarter of gross receipts in 19, she may be able to do a fourth quarter, with the caveat, and this will be coming up too. You guys are stealing a little bit of all our, but is there? I'm going to put a huge asterisk on that. We don't know if the fourth quarter of 2021 is going to be eligible for the ERC or not. There's provisions in Congress, if they ever get their act together and pass current legislation, that would actually end the ERC as of September 30th. So, Amy, I think that the only only possibility would be is if they had shut during the shutdown period in 2020. Now, this last statement here that we have, compensation paid to individuals related to a 50% or more owner are not considered qualified wages. This is probably one of the biggest significant stumbling blocks, I think, that a lot of people were trying to figure out what this meant. And so we're going to go through what is a related party and what qualifies and what doesn't under the related party rules.
Jamie, let me jump in here because I've
Yeah.
popped back that one of the problems, this is my fault, I say compensation paid to individuals related to 50% or more, it should be more than a 50% owner. If you're a majority owner of the company, we're basically saying that if it's a related individual, your sons, your siblings, full or half blood, your ancestors, descendants, etc., those individuals, you cannot, at this point in time, their wages are excluded for purposes of the employee retention credit.
Right.
So if you're a majority owner, you own 50% more, or 50%, or you own more than 50%, you can just scratch off ancestors, you can scratch off siblings, you can scratch off descendants. Their wages do not qualify. Why? The reason is, and this is, Congress looked at it and said, you know what's going to happen? People are going to see this ERC and they're suddenly going to start hiring their parents, their brothers, their sisters, their in-laws, and their children, and their grandchildren. And they're going to say, why shouldn't we? We get 70% of it funded by the federal government. So they put this provision in place to say, no. Now, is it overly broad? Probably is. I've got one client where literally it's an engineering firm. He's got 3 of his children working at the firm and 1 brother. They've all been there 20 plus years. They're core to the organization. There's no game playing there, but they're all excluded. Their wages are excluded because they're related to him. So just keep that in mind, but it's got to be more than a 50% owner.
Right. Right. And so the attribution rules are key here. And this gets very, very technical. And to some extent, this is where we'll give you a little bit of an overview, but at the end of the day, you're probably going to be better off discussing to some extent some of it with your tax preparer. I think that as Bob explained it very elegantly, is that anybody related to 50 down the line, just imagine a family tree and just go straight down the family tree, and everybody on that family tree is probably going to be excluded somehow, some way. From this, one of the areas that I think is overlooked, and this again, this gets a little bit on the technical side, but it's something that I think everybody needs to know, is what they call partnership attribution rules. And that essentially says that if let's say Bob and I are partners in a corporation, and then we also own the real estate that owns the operating entity that we work out of, and we pay rent to it and so forth. Bob and I are not related, at least the last, I haven't had a DNA test, but I'm pretty sure we're not related.
We have the same UPS delivery, man. Are you sure?
Right, exactly. So, so pretty sure we're not related. However, because of the fact that we own a partnership together and a corporation, that through some rules within the code basically say that now Bob and I have a relationship together relative to that, and then we would now all of a sudden we would be excluded if we were owning 50%. If I own 50% and Bob owned 50%, the attribution rules say, well, now I own Bob's 50%, so now I'm 100% owner, and Bob is related to me, so now he's excluded, and he's 100% owner through rules of attribution, so I'm excluded. So there can be issues relative to partnerships that could exclude the partners from qualifying for the ERC wages as well. Again, this is a little on the technical side, and I would advise that you do talk to your tax preparer on this, but just be aware that there's an issue relative to partnership rules that could cause some issues. Yeah. And then, as we talked about, really the only way that this works for a husband and wife, the only way that this works for majority owners to be related would be as if it's a husband and wife ownership, and they have no other living siblings, descendants, or ancestors. Basically, their family tree is a stump. Ends with them, starts with them, ends with them, and there's nobody living. Then they would qualify And that's because there's an issue relative to the attribution rules excluding the spouse out of those rules. So they would end up qualifying because there's no relationship to each other. It's really kind of bizarre. But so if you happen to be in a husband and wife relationship and you have no kids, no siblings, no descendants, ancestors, or anybody's, then congratulations, you guys get to claim your wages for the ERC. Everybody else, and if you're 50% owners or more, majority, it's not going to work.
Yeah. Let me kind of give you the big picture on this. And this is where I would say the flags are, you should talk to your tax professional. If you own more than 50%, you can pretty much assume that anyone that's related to you that works for you, siblings, ancestors, descendants, yourself and your spouse, your wages are all going to be excluded. If you own more than 50% and you have no lineal descendants, you have no ancestors, and you have no siblings, then at that point in time, you don't have to worry about their wages being excluded. They don't exist. But suddenly, miraculously, your wages and your spouse's wages now qualify. Does it make sense? Absolutely not. Is it the law? Absolutely it is. Does the IRS understand it? They do. Do they like it? Actually, they don't, but they've gone through and said, you know what? This really makes no sense from a policy standpoint, but it's real clear what the law is. And even though it probably should have a technical corrections, it's never going to. So we're stuck with it. So long and short of it, own more than 50%, your kids, your parents, your brothers, your sisters, nothing for them and nothing for you or your spouse. If you happen to be that unusual person, like Jamie said, where you're the stump on the family tree and that's it, you have no siblings, you have no living ancestors, you have no living descendants, then you and your spouse's wages can qualify.
Right. Amy, you provided us with another good question here. I looked at, indicated she looked over the internet to find out the partial shutdown dates for restaurants and didn't have any luck. And I don't know if I have access to the data. I know that from not being able to go to some of my favorite restaurants, I know that the shutdown was through most of 2020. I mean, there were some dates where they opened fully back. I don't think the restaurants were ever fully back opened until almost April of 2021. But right, Bob, I think that I think that the restaurants would be one of the ones that would be, because I think it was around April time that they started allowing more than to them to open up in full.
Yeah. The best way to look that up would be the executive orders from the governor.
Well, keep in mind though that the restaurant at some point they stopped coming out as executive orders because of the I think they came out of MIOSHA and Health and Human Services.
Yep,
I think is where they came out of. So and you know what, it's possible that I know that Lori has a I think that SBAM has a relationship or something with the restaurant association. Maybe she can find those dates for you and communicate them. That might be the best bet. The Michigan Restaurant Association would be probably the best place to go.
Yeah, so, I will do that. I will see what we can do to find that out for you.
Okay, yeah, I appreciate it, Lori. Thank you.
Yep.
Good, great questions, Amy. I think Amy's going to keep us on our toes, Bob, the rest of the time. So I appreciate it, Amy. So good, like it. So we've got a few examples, and I'm not going to read the examples. You're all going to get the slides, but it covers exactly this Rev Proc 2021 that the IRS came out with relative to defining all of that, and but essentially says exactly the same thing that we did. This one here is a parent and child shareholders. Essentially comes down to the conclusion that nobody qualifies for the ERC in this particular example. The next example is a child of a shareholder, not an employee of the business, and you've got one person owning it 100%, but because of the fact that the kids own that 100% as well, and the parent is related to the kids, that excludes the parent and would not qualify for ERC wages as well.
Yeah, don't get lost in reading these things because you're gonna go like my head's
Yeah.
spinning.
Yeah.
If your head's spinning, then you're in the perfect state because it just doesn't make any sense. But if you'd have to go through all the attribution rules, long and short of it.
Right.
You're going to be stuck with your wages are going to be excluded.
Right.
Unless you're
And
in this
this
scenario.
and this is the scenario of the husband and wife with no living relatives. Basically comes to the walks you through, comes to the conclusion that they would both be treated as qualified wages.
Yep.
And then this is that one on minority shareholders, and that the fact that because you're non-related and they're own less than 33%, that at the end of the day, they would not necessarily be treated as qualified wages as well. So again, these are some reads if you really want to try to go to bed at night and so forth. I'd tell you to call up the slides, and I'd tell you to go through the whole slide presentation and probably fall asleep before you even get here, but maybe skip to the good parts of this section. But just some examples coming right, and these came right out of the notice that it was there. So this is right from the IRS's own examples. So now that we've talked a little bit about this chart here is just a quick summary of the differences between the ERC in 2020 and the ERC in 2021. We've covered a good portion of this. Both 20 and 21 allow for $10,000 in wages, but the difference is 20 was for the year, 2021 was per quarter, and then the credit amounts 50 to 70%. And then the gross receipts comparison, as we talked about, and what defined a large employer, and then the periods that they covered. And in this example here, as I stated earlier, the ERC was supposed to go through 12/31/21, so you're supposed to get 4 quarters. However, the new infrastructure bill that's still in Congress potentially would end the ERC at 9/30/2021. Now, Bob, I have a question for you, and this is going to be testing your legal knowledge and so forth. What happens if they don't pass that bill until 2022? Do you think it still goes retroactive and shuts it down after the quarter end, or do you think they allow it?
Well, it's an interesting point. Depends how I haven't read that portion of the legislation. If it's got an effective date already, that it's going to be effective as of
right,
as of the date of introduction, then it would cut it at 9/30. If it's effective prospectively, then you're going to get the 4th quarter. What I'm telling people to do right now, and what we're doing with our clients, is we're assuming it will be gone.
Right.
We are still tracking everything. And if by happenstance, 4th quarter is still available to us, we will file an amended 941. That's a 941-X for those who are really, really, detailed oriented. And your CPA or tax preparer will file that for you. And that's the one you have to paper file. That's the one that usually I tell them that you should probably put in your wills and trust as to who's going to get the refund from the IRS.
Right.
But it'll finally get to you sooner or later.
Yeah. It'll get to, and then they'll send it back to you in paper format as well.
Yep, they will. They'll send you a check. So.
Okay, so
yeah, if I were looking, if as a participant in this webinar today, if I wanted to look at one slide, this is the one I would look at.
Yeah,
it gives you the core: 10,000 per employee, 70% credit, 70% on 10,000, 7,000 a quarter. I got to have a 20% reduction in my gross receipts compared to the same quarter in 2019. I'm going to assume most of us have less than 500 FTEs, so we're good. We don't care if it's wages paid for working or not working. And it looks like it's going to qualify at least for the first 3 quarters, maybe even Q4. We'll see.
Yep. Okay, so let's look at we talked about this decline in gross receipts, and I really think that this is where most businesses are, the biggest opportunity for most businesses are going to be able to do this. And the nice thing about the ERC compared to the PPP and some of the other things in the CARES Act is this allows us to, this credit is going to live on for the next 3 years or so as returns stay open for amending. So, well, you don't have to do this right away. Obviously, the sooner you do it, the chances of the sooner you get your money. But it is something, especially in the decline in gross receipts, it allows you to take some time to really look at, did we qualify for this under the defining the decline in gross receipts method, and looking at the quarter, because this is where a good portion of, I think, the credit is going to come from. So way that they've explained this is that decline in gross receipts begin. So when you're going to measure this and you have a decline in gross receipts, you look at it begins. So your period, in that period of decline in gross receipts, will begin the first day of the quarter in which the decrease occurs. So if the decrease occurs in the second quarter, then that's when you get to start to count the wages in that quarter. And then that'll go through until the end of that quarter, plus the end of the quarter in which your gross receipts finally get back to no more than a 20% reduction, or you have 80% of the same quarter in 19. So you're always going to get the quarter that the gross receipts occurred in and the quarter after that, because it begins the quarter after that decrease. So, and we've got an example of this, so I don't want to get too confused and try to go into this too much. I've got an example in the next couple slides to kind of articulate that.
Let me make a clarification on this.
Yeah.
Because the credit does begin in the quarter in which you qualify. But keep in mind, you can qualify under the 2021 rules using the prior quarter.
Right.
So in our example, the first calendar quarter in which the decrease occurs, that's my fault again. I should have said the first calendar quarter in which you qualify for the 50 or 20% test. That the 50% test, let's ignore the 50% test. If you have any questions on 50%, talk to your tax preparer. If he doesn't know, talk to Jamie or myself. We can walk you through that. Let's just deal with 2021 because that's the big bucks and most of us are dealing with. If the first calendar quarter which we qualify could be Q1 2021. However, I might actually qualify for Q1 2021 based upon the prior quarter, last quarter of 2020. So it's the first calendar quarter which I qualify. Well, I qualify for the 2021 credit based upon my Q4 2020 reductions. Because in Q4 2020, in this example I'm making up, is my gross receipts were more than 20% less. I had a greater than 20% decrease in my gross receipts for Q4 2020 compared to Q4 2019. Then I don't care what happens to my gross receipts for Q1 2021. They could be 300% higher. I still qualify for Q1 2021 because of what happened in the prior quarter. It's weird, I know, but what can happen is I could qualify for Q1 2021 based upon 19's numbers. I could qualify for Q2 2021 based upon Q2's numbers because I can't go to my prior quarter, which we're talking about in this example, because it was higher. So right. That's the game we're playing. So it's the first calendar quarter in which you qualify.
Right, and that's that alternative quarter comparison
yes.
that we can look at, right?
Yes.
And then then they came out with a rev proc that helped us define gross receipts, because this was a big challenge with us, is what was part of gross receipts, and they allowed us to exclude the forgiveness amount of PPP. And I remember, Bob, you and I having a conversation early on about this, is how do we treat the PPP forgiveness, and you and I had decided prior to this to just amortize that over the forgiveness earned versus
right.
to help smooth out this, instead of having one big gross receipt. This rev proc just kind of threw that out the water, as with everything the IRS has done and Congress has done through all of 20 and 2021 for us. So and if anybody has received the shuttered venue or the restaurant revitalization grants, those are not part of that. So right. A couple things to consider when you do the gross receipts. Before I move on to the example, Heidi has a great question here. Eligible period was from 3/23 to to 6/1/20, but your table shows 3/12/20. What is the correct start date for wages in March of 2020? I believe that it depends on how you're doing that. I think my 3/23 date is the date that the stay home, stay safe order came into play. And so that's a state date relative to us having the partial shutdown, full or partial shutdown, which if you're going to use the full or partial shutdown, you would start from 3/23 is when the state ordered the shutdown. Now, some industries started shutting down earlier, some business like schools and stuff like that shut down earlier. So it could be possibly earlier than that. The 3/12 is the federal date, and that would be really would be applied, in my opinion, and Bob, and correct me if you think differently, is if you're going to look back as comparison to the 2019. And if you had a decrease from there, that's when the law was enacted. And so that's when they deem it to kick in. So I think that's really what you're looking at, the difference in the difference there. So both dates are right. It's just depending on how you're applying them.
Yep.
So, but great question, Heidi.
Quick thing on the gross receipts. Keep in mind for gross receipts, it's receipts of any type, but the things you do get to exclude is the PPP forgiveness amount. Don't include that as part of your gross receipts, as Jamie's saying. If you've theater operator, something like that, shuttered venue operators, those grants do not get included as part of your gross receipts. If you're a restaurant and you qualified for the revitalization grant, you do not include those proceeds as part of your gross receipts, which is very, very important, because for many of us, if we threw in PPP, shuttered venue, or restaurant revitalization grants, we would not qualify. We would not have a more than 20% reduction in our gross receipts for many quarters. So that exclusion's very, very important in determining if you qualify.
Right. So let's just kind of walk through an example of what this looks like, because this can be a little bit confusing in overall. Mm-hmm. So that's just, my mouse has been moving. So let's just take an example of this is what your gross receipts look like. And one of the first steps that we do when we do this analysis is exactly build this chart out for the most part. Is I put this on my Excel document as we're documenting everything. So I have an exact of what the gross receipts down. So we look at this, and real quick, we see that we've got a 10% difference in quarter one, a 52% decrease in quarter two, a 37.5% decrease in quarter three, but they made up a good portion of this in quarter four and started seeing uptick, which I've seen a good portion of my businesses clients in 2020 actually start to see a Q4 uptake as especially in the non-restaurant. Unfortunately, the restaurants and stuff were the ones that were hit hardest, but in a lot of my professional clients and stuff started to see an uptick in that fourth quarter as they were starting to get back into full swing. So based on the rules, we would know that quarter two would start the covered period, or would start the declining gross receipts period. So, but because of the fact that in quarter three, we still had more than a 20% decrease, quarter three is eligible as well. And then because it doesn't, the way that if we go back to that rule, it says here that it's the quarter following in which we have this 80% or the inverse, the 20%, more than 20% decrease. So with that being said, because we qualify here and we qualify here, this is the first quarter in which we have had more than a 20% or less than a 20% decrease in our gross receipts. So we would look and say that this example, we would be able to qualify for the ERC for quarters 2, 3, and 4.
Right. Now keep in mind, this is 2020.
Right, 2020, exactly.
So this is a rule for everyone. This is where that prior slide is completely accurate. It says it starts in the quarter in which we have a greater than 50% reduction. We can't look at the prior quarter. For 2020, it starts in the quarter in which you have a greater than 50% reduction, and it continues to the quarter after you've got a greater than, that your reduction is less than 20%. Well, just like Jamie said, greater than 50% reduction in Q2. Q3, we still have a 37% reduction. That's still fine. Q4, it's positive, but we get Q4 also.
Right. And the funny thing is this kind of goes out the window of start, ending, and including, because it's the 20%. It already starts at 20%, Bob. So
Right.
it's already, so it already kind of 2021 kind of takes care of itself, and it's a quarter by quarter
Yep.
look at for the most part with the, so all right. So somebody had asked the question early on, I think, in about recovery startup businesses, and this is kind of new. This came out, and I don't know where this came out, if this was a IRS pronouncement or if this was a out of Congress, but I know that this recovery startup business,
Yep. It was congressional. Yep.
it was congressional that allowed for. So they were concerned about those businesses that maybe were still paying employees, but really didn't have a look back, started out during the pandemic. And so ultimately what they've said is that if you're a startup business that started before, or I'm sorry, it started after the pandemic started, remember the February 15th was the official start of the pandemic. And you decided that you wanted to be daring and open up a new business. And there's a lot of people that had businesses in the works relative to this, and your gross receipts were under $1 million. And you were not eligible due to the shutdown of or decline in gross receipts. And rightfully so, you don't have them, but the shutdown, you were able to qualify for the ERC for at least the third and fourth quarters of 2021 for up to about a $50,000 credit per quarter. So that's roughly at $7,000. That's roughly 7 employees. If you were paying them $10,000 a quarter, that you'd qualify for. Bob, the funny thing I see about this, though, is Congress writes this, and then on the other hand, they've got a bill out there that says, oh, by the way, this ends in the fourth quarter. So the recovery startups are going to get 1 quarter worth of ERC. This is the way I read this.
Yeah, and I haven't looked at the Biden Act closely enough. I would have to look at it, and I can. If anyone's got a question on this, and this is important to them, why don't you email us and we'll respond to you?
Yeah.
We'll have to take a look. I would not be shocked if there's a carve out that says that if you're a recovery startup business, you still get Q4.
Yeah, it's very, very possible. But this is still, again, to me, and there's really, this is just all you have to do is started your business before the 15th. And I know, Amy, and I don't mean to keep picking on you, but like I said, you had some really great questions that you had sent us. So one of them is can a recovery startup business for the short term prior to COVID and then closed for the year, shut down payroll in the business and reopen as a going concern in a new location? I don't think we're going to find specific guidance to that question, to be completely honest. However, common sense approach, and I hate to use common sense and the tax code in the same sentence because it just doesn't happen, but common sense would tell me that if you maintain the same tax ID number when you open the business pre-COVID and shut it down and you came out of COVID or opened the business after February 15th with the same tax ID number, I would say that you're not going to be eligible as a recovery startup business.
I would agree.
Now, if you open up everything brand new, including a new tax ID number and business registration and all that, then yeah, I think you could do that. So just wanted to make sure we addressed your question there. Okay, and I think we had somebody early on that I think that SBAM had answered for us, and I appreciate that, relative to how does this all work relative to the other with PPP and other credits that are out there. And this is where having somebody that knows the rules can help you maximize out the ERC and the PPP. Because of this, the fact that they are not going to allow you to use the same payroll costs for the PPP and the ERC, you have to be very specific on which wages you're using for which program. And so but you are allowed to cherry pick which wages and how they're applied. And so going through and doing an analysis of what is your PPP wages and what is, and I don't know about you, Bob, and I'd be interested to know how you do it. And for how I do it, I literally will create an Excel sheet and put every employee down on one column and put their payroll per payroll period going across. And then I'll start kind of, in a way, I have a method now, but I'll start cherry picking and highlighting which wages are going to which program. So that way I've got documentation of what's used for the PPP and what's used for the ERC.
Yep, I do the identical thing.
Yeah, great minds.
Yes, that's it. Keep in mind, you can't double dip the wages. So if you're using wages for PPP, you can't use those same wages for an ERC credit, for SFOG credits, grants qualification, or for restaurant qualifications. The wages can be used for any one of those four, but it can only be used for one. So this is why you've got to allocate. For most of us, it's an allocation between PPP and ERC. That's what most of us are doing. So just like Jamie, I'm doing the exact same thing. I start on January 1st for 2021. I run it through currently. I then have the pay period, my for PPP. I look at the time period for the, I'm blanking on the term, covered period, 24-week covered period. And I'm allocating those wages out to PPP. If I can't maximize my employer retention credit, then you want to minimize the amount of wages used for PPP, which means you want to throw as much as possible into the non-payroll costs. That's why for all of our clients, we have told them we will not apply for employee retention credit until we've got their covered period completely done. And then we've completed the allocations of all their costs for PPP to see if we need to maximize non-payroll so we can free up dollars, wage dollars, and allocate them towards the employee retention credit.
Right.
Keep in mind, for all of these, on top of not being able to allocate wages to PPP, ERC, SFOG, and restaurant programs, it's one or the other of those. I cannot claim credits that I've already applied to the employer tip credit, the R&D credit, the family medical leave wages, if they've been reimbursed by that, qualified sick and family leave, Indian employment, active duty, all those things listed below. If you're getting credits for those, they don't qualify for any of the above programs. You've got to exclude them.
I know we're coming up on the hour. Lori, do we have extra time to be able, or should we try to blow through we've got about 6 more slides to go.
You're fine to go through. If folks have to leave, you can catch the end of the recording.
Okay. Okay, perfect.
Thank
We'll
you.
try. We probably try to get done in about another 10, 15 minutes. So we'll try to go through.
It'll just seem like an eternity.
Yeah, right.
It's long. Well, it's pretty in depth. You guys do a great job at unpacking it. So keep going.
All right. So the next one is just this is a quick example of the PPP and how they interact and what's available. And to Bob's point of what we talked about earlier is assume that we've got a $160,000 PPP loan, and depending on how we apply for forgiveness on the application will determine what we have available for the ERC or what wages we have. So if we have a PPP loan and we only have 160 and we only have wages of 160, then we don't have any remaining wages for the ERC. In example 2, we assume that we had $160,000 in PPP, but we had 140 in wages and 40 in non-payroll costs. That means that total forgiven costs were 180. We can now pull 20,000 of those wages and use them for the ERC because we had the $40,000 of non-payroll costs. So, and then example 3 is the same thing, but it allowed for a higher wage application, even though maybe you put higher wages on your application, because of the fact that you put payroll costs on your application or non-payroll costs on your application, we're able to use those against the PPP. So in I guess where I'm getting at with this is making sure what you put down on your application for forgiveness. If you put no non-payroll costs, then that leaves you very little leftover payroll available for the ERC.
Yeah. And
So-
again, if you've got any questions, and this is going granular, feel free to have your CPA or tax preparer get a hold of Jamie or ourselves. We'd be glad to share the types of worksheets that we do. And they can clone them, work with them. We just want you to maximize the benefits
Right.
that are available.
All right, in claiming the ERC, the current quarter, I think that unless there's something changing in it doesn't come through, I think the current quarter's out. Normally what you would do is actually apply for it through a reduction in your 941 tax and so I don't think that that's going to apply for most people now that seeing that we're midway through the fourth quarter. But however, you still, if you haven't done it and you meet some of these qualifications that we've discussed, you are able to amend your prior 941s and claim the credit as a claim for refund by using Form 941X. Now, again, I think we talked about this early on, is that you're going to have to paper file this. There's no way to electronically file this, and you're going to be subject to IRS processing times. And again, I'm telling clients 6 to 9 months. I don't know, Bob, if you're telling them longer, or like you said, put it in your will to give it to their heirs or what have you.
Yeah. Now, one thing to keep in mind, this is what Jamie mentioned earlier. This isn't a fire drill. So you could easily wait to next year to do it. You've got 3 years from the due date of the 941 to amend it. So this is when Jamie said you've got 3 years to do this. That's your 3-year period. We have plenty of time. Don't delay it. But if you need to get your ducks in line and get all your documentation together, and your tax professional says, oh, I'm already swamped, can we do it next summer? You can.
Yep.
If you need the revenue more rapidly, the refunds, the earlier you file it, then the earlier you're going to get it.
Yeah, and I think that realistically too is the longer that the IRS starts to catch up on things, that we should see shorter. So you may be even, it may be 9 months from today, but you wait 3 more months, it may be 4 months. And so you're still better off waiting. So I don't see you're losing much time by necessarily filing later than earlier. Although,
Right.
Again, I think people are wanting to get into the rush of this and so forth. I also think that there's going to be a little bit of delays relative to this, possibly depending on the dollar amounts, because the IRS is going to be looking at some of these rules that they put in place to maybe see if there's some opportunities to provide some sort of a audit, whether it be a paper audit or an actual in-person audit. I would imagine it'd be a correspondence audit would be the first way that they go. So, but again, I'm starting to hear rumors that clients from other CPAs are starting to get their refunds. One thing that I did want to mention to you is that there's no ability to double dip the wages and claim it for the credit and then claim it on your tax return. So, right, as a deductible wages. So let's say, for example, you had 10 employees in 2020 and all of them qualified for the ERC. And so you got a $50,000 credit in 2020. And that's great. You amended the 941. You needed to make sure on your 2020 tax return, your business tax return, you reduced your wages by that $50,000, because you're not able to deduct anything that you take credits for, and that's always been the rule relative to that. So if you haven't, if you're going to go back to 2020 and file your 941s and get the claims, more than likely that your tax preparer is also going to have to amend your business return, which is going to then mean that you've got higher taxable income. And then the problem you're going to run into is the timing of the filings. And maybe what you do is you delay. I mean, you've always got 3 years to amend your return. So maybe you amend your business returns later than you amend the 941s to help offset that difference. Because, let's just assume that argumentatively, you're in a 22% tax bracket for a business. You're going to pay on $50,000. You're going to pay a little bit over 10 grand in taxes, but you're going to get $50,000 in credits. So you're netting out a positive $40,000.
Yeah, it's still a good deal.
It's still a good deal. Yep.
Yeah. So
Yep.
Don't be mad. It's a good deal. Now, the one weird thing, you're going to say, wait a minute, I didn't have to do that for the PPP. I got my forgiveness and I didn't have to go back and amend my tax returns and reduce my wages or my expenses. You're right, you didn't. Congress made a very specific provision that said you didn't have to reduce your deductions for this tax-free money that you received from the federal government. It's a one-off. The normal rule is if we give you these tax-free grants, et cetera, you don't get a deduction for what you spent it on.
Right.
TPP is the one exception.
Yep. And that had to be written by Congress for that to happen. Because if we remember, IRS was telling us we couldn't take the deductions for those things.
Right.
Bob, we got an interesting question here that I have not heard. And so I have heard some refunds were being reduced due to debt ceiling. I don't follow politics. Is this a real thing? I'm going to go on a limb here and say, no, it's not a real thing. But I don't know if I mean, maybe the fact that the government doesn't have the ability to pay out some stuff that maybe there is something there, but they're not related specifically, but it could be just in the way the government's issuing refund checks and so forth. I don't know. Have you ever heard of it?
No.
Yeah.
No, I have not. And it would probably be true that they might have to postpone if they hit the debt ceiling and we did not have anything that would allow for additional funding. So it would shut down the government because that wouldn't be part of the emergency services that has to continue working without comp. The stuff that they had to pay out were things, for example, like Social Security, Medicare reimbursements, things like that. But yeah, it should be a non-issue. It should be because Congress should be responsible. So that's enough. That's a completely
you're a funny guy, Bob. Funny guy. So we're going to kind of conclude on a little bit of a technicality. We referenced it earlier before and really didn't say any much about it, but this IRS notice 2021-40-49 came out, I want to say September or so, maybe end of August, September timeframe-ish, that essentially cleared up the related party issues into 50% over. Prior to this, the IRS website basically said the 50% share or 50% or greater and the wife were never addressed their ability to take the credit, but said anybody related to those would be able not to. And so a lot of practitioners and a lot of people, quite frankly, prepared amended returns and took a credit for the husband and the wife as qualified wages. Then fast forward to September, the IRS now came out with notice 2021-49 and basically said no, and went through those rules of attributions and said, no, owners of 51% owners or more and their spouses, because of the rules of attributions, are not considered qualified wages. So then the question comes down to, well, what happens to all of us that had prepared returns prior to this notice? And I've got a few clients that are this way. I'm sure Bob's got a few clients that are that way. I'm sure some of you are that way. And what do we do about it? And there is no, I'll be honest with you, we're not going to see a legislative fix on this. I don't think the legislature has any more appetite to open up anything more related to the CARES Act or clear anything up or do a technical correction. I think they just want to move forward. And quite frankly, they've got bigger things on their agenda. Bob, I think that you and I talked about this prior to coming onto this call. And, looking at it from the business owner's perspective, the IRS is saying you have to amend your returns to fix this. So now you have to file an amendment of an amended return. So there should be no confusion in the IRS's eyes whatsoever at all. But technically, they're not going to hold a gun to your head and say amend your return. So taxpayers and business owners, they can proceed at their own risk if you choose not to amend the return, knowing that they should. However, I would give it 100% odds, 99.9, that nothing's ever 100%. That upon audit, if you're audited, they are going to disallow any of those wages of the owner or the spouse in used in determining the credit. So you have a potential of about a potentially of a $10,000 in 2020 repayment to the IRS, and potentially what would it be, $42,000 if you took the credit for every quarter in 2021. So you kind of have to assess that risk of what you want to do. I think that even though you don't amend, I'm not sure that the IRS would be able to assess penalties, because you could make an argument that you relied upon guidance at the time and then you never look back at it. However, you've attended the seminar, and so now you've been known, so maybe you knew what the guidelines were, and it should be amending. The other thing that you have to look at is your preparers are going to have to, if they're CPAs, will be subject to various professional and IRS standards in preparation of tax returns, and so they may be requiring you to amend the return as part of their meeting their professional standards. And again, so it's something to discuss with the preparer.
Yeah.
You know, Bob, with this, I don't know where this is going to end up with the, you know, how the IRS is going to go after this. Any thoughts on that?
Yeah, my attitude is this, and so I'm telling my clients that have done it. If you happen to have included your wages and or your spouse's wages as qualifying for the ERC when it didn't, because you were more than 50% owner and you had surviving ancestors, children, or siblings, so you just don't qualify, then I've been telling them, amend the 941Xs that you did. Just
are you so this brings up an interesting question, is I'm half tempted to wait until my clients get their refund, tell them to hold back on some of the, you know, to set some of that aside and let's file and pay it back, versus trying to amend while the amended return is still being processed.
Yeah, I'm just having to amend the amendment, so it's just done.
So you've got two amendments sitting in IRS processing right now.
I do. And I figured that way we're just done. If the IRS gets to it, I fully expect what they're going to end up doing is they're going to issue the check for the full amount. And then later they're going to issue a notice saying there's a deficiency and we have to refund it. But if they happen to net the two, great, we're just done. My point is that your really responsible tax preparers and your CPAs are going to have to give the disclosures to the IRS. It's a flag. Just do it. We know what the rules are. Be done with it. It's not worth arguing. Even if you argued and by an act of God you won in the courts, you still lost. The court fees and legal fees will grossly exceed the employee retention credit benefits you're going to get from it. So it's like, let's just be done with it and let's just move forward.
Because keep in mind, you're only doing two. There's only two people you're talking about. So the highest, right? And so the only time that it becomes advantageous is if you happen to qualify for the ERC for first quarter or sometime in 2020 and all three quarters in 2021, you're looking at about $51,000 in credits back to you on those two people. That may be worth somebody pursuing and challenging the IRS on it. But at the end of the day, I think it's going to be they're going to be in a net loss situation. And then going forward with this is that no matter what, now this is now the IRS's guidance. And so you're going to have to take this under consideration when you do it. And there's a form 8275 that requires you to have a disclosure if you're taking a different opinion than the IRS. And I know there's a question earlier in the emails relative to is an 8275-R or an 8275. It's an 8275 because an R is a regulation. This is not a regulation. This is an IRS notice or pronouncement. So it doesn't qualify as a regulation.
I love you, Jamie. You just go into all the details. You're the CPA.
Right. And so just to say, and then Amy, we've got another question here. I thought I was going to be considered a late for payment, possibly subject to 5 to 25% penalty. Amy, that's in a situation in which you file the return, and I don't think that they're good. I think the IRS came out and said that they weren't going to penalize that if there was a shortfall and you made the shortfall up. You're referring to if you take the credit in the actual quarter it occurs, We're talking about amending prior year amended returns. So there's a difference there.
Yeah.
In those two. So again, where I say there's no penalty is that there's no penalty on amended returns or audited returns. Potentially, you could argue that you used it based on the guidance at the time, which I believe that the IRS said now they're freezing and making archived available of all their FAQs, this is where one of the FAQs came out of. So I think that you would be okay with that.
Yeah, I think you're right.
So, all right. So I appreciate everybody hanging on for an extra 15 minutes. We apologize for going late. Bob and I have just way too much fun doing this. You guys have been great about asking questions as we go along. Give a couple minutes to see, or a minute or so to see if anybody's got any questions. Lori, I don't know how many people we still have on, if it's worth just opening up the mics to see if they've got questions or not.
Quite a few. I do see one that just came in. Actually, I think it was in the chat. It was regarding
50 do health insurance count for 50% owners. I think that would be because of the fact that the health insurance is part of the definition of qualified wages. I think you would still go through the same related party issues, and so yes, it would.
Yeah, of course, there's different rules if you're S corp or if you're C corp.
Right. And so
go talk to your tax professional.
Right. Or give us a call or shoot us. We're going to provide the slide deck to Lori. Lori will then provide them to you. In there, in the last 2 pages are Bob and I's mugshots with our contact information and a little bit about all of us. So you feel free to send us an email or give us a phone call. Certainly glad to help anybody from SBAM out as best we can.
Yeah, but if you put an email in the subject line, if you put SBAM question or something, that way it'll flag it for Jamie and I.
Yep.
Otherwise, I'm sure it's the same thing you guys run into. You get your 450 emails a day and you go delete, delete, delete.
Right. And if you don't get an answer,
send it again.
Send it again or send it to Lori. And because sometimes, new emails get caught up in spam, but Lori's a safe email. So even if you want to send it to Lori and have Lori forward it to us, I know I would get that for sure.
Yep, same here.
Well, great. Thank you so much. Special thanks to Jamie and Bob, and also to the Michigan CPAs. We really appreciate this partnership. And it's obvious that all of this is as clear as mud. We appreciate you unpacking it and being able to talk over these questions with our members. And thank you for the follow-up. Very much appreciated. So Thank you, everyone. This will be recording, will be out there, and I'll get the slides too as well.
Great.
Okay.
Thank you.
Thank you, everybody.
Bye-bye now.
Bye.